I'll tell you what, bro, like one of my favorite days of the week is sitting down to do this stuff. But then when you add in the fact that this is going to be like so deep in relation to the property stuff, like I feel so much more confident and excited about the new year now that I've seen this than I was before.
I always just love January and just coming back in and getting all of the predictions from all of the big dogs in the industry and just, you know, easing a lot of concerns and just getting a bit of a different perspective about how things are actually going.
Yeah.
Because there's such diversity between what we see from guys like Phil Anderson and Michael Matusik and Simon Pressley and CBA versus what's going on externally in terms of like the major media outlets and things like that.
Yeah, it's funny, like I heard this quote over the Chrissy break and it was around this idea that as issues get less intense, the severity of the noise around them gets higher. And so it's like, it's that human nature thing of like grabbing on to squeeze out the last bit of the fear juice around interest rates or property prices. And so it gets noisier, but in reality, the issue is softer. And I was like, isn't that the fucking world that we live in right now?
Yeah, just seriously so over sensationalized, and they're just trying to grab our attention and, you know, keep us looking at the screen, basically.
It was actually in relation to social media, and it was this concept that the world is actually getting exponentially better on average every single year, and so is the average person's life in the world. Obviously, there's some people doing it very, very tough right now, but on average, and as the world has gotten softer and nicer and calmer and the consciousness is increasing, the noise around how bad the world is getting worse. But that's the natural thing at the end of these things. And so it's like, it's cool to know that.
It is really cool. And what we've noticed, because what we've just sat down and done for the last close to an hour is just, we sort of grab our cup of teas, we go and have a look at all of the different articles, all of the different predictions, all of the different information that's come out from late December, early January 2023. And what we're going to do now is just sort of talk about what we've sort of come to find and what all of these people, what these industry experts are actually indicating that's going to happen moving forward. So I'm really pumped to get into it. Do you want to kick her off, or?
I just got to say, guys, like, rant alert.
Rant alert.
Some stuff here that is just so exciting to me from Phil, CBA and Simon Pressley that, you know, just get on board and come down the hole because it's going to be a ride for the next 30 minutes or so. Where do we start? Maybe we start with the great Phil Anderson.
Yeah, let's start with our favourite.
So Phil's the man. He's been the most accurate person, more accurate than even Commonwealth Bank, the RBA, or Simon Pressley have been to me, following him for the last 5.5, 6 years now.
And Phil's kind of not really the dude that's going to throw out specific predictions, but he's just going to go, this is the state of the economy right now, and this is why the economy is in this state, and this is what could potentially happen next.
It's exactly right. Paper's gone. You know, just this idea, I suppose what Phil does for me is like most people and investors, I can have the hand right in front of my face and sometimes I can't see, but Phil constantly pulls my hand away from my face so that I know that it's there, but I can see the bigger picture at the same time. And that has been gold, the perspective he's helped us get. But, you know, my writing's hardly legible even for me, so just persevere as I get through this, choke through it here. But I just read Phil's 2023 roadmap.
Yeah.
You can subscribe to his stuff at propertysharemarketeconomics.com or .com.au, I can't remember.
And their YouTube channel, Property Share Market Economics, where they do pretty cool videos every now and again.
Really cool stuff. So you can subscribe to their free stuff. I think they've got a paid subscription if you want really detailed stuff. As a property investor, the free stuff's been great. As a stock market trader, which I'm not, the more expensive stuff is been very helpful for clients of ours. Priestley, we've got $120 billion of committed government projects in the next 10 years in Australia alone.
And I recently saw an article from Darren Wilson where he was talking about the cranes in the sky, and there's more cranes in Australia than there ever has been in history at the moment. Something like over 350 cranes in the skyline around Australia, which is a new record.
Amazing. Is your tea still cooking you, or are we ready to drink?
I'm ready to drink.
I was just thinking about mine. I'm a
I might start sweating a little bit earlier, so sorry for those that are watching.
You're going to be a sweaty mess by the end of this. I can feel the sun starting to come through, eh?
Oh no.
We're like, this year we're like, let's start wearing shirts on camera was like the general gist of like where we're going. My wife's like, if I see you on camera again with your shirt off this year, but now that we're in shirts, I can see why we don't wear them. It's fucking hot. What Phil did is he basically looked at all of the experts, like your HSBCs, your Stanley Morgans, your big dogs, your Barclays banks, and looked at what they're saying around real estate in the US and what they're saying about stocks for the year ahead. And then what I loved is he gave like a little rating system for how accurate he thought they were based on his position. And some of them he was like a 10 out of 10. He's like, they're spot on. And others are like, this is just absolute horseshit. Yeah. Which he, and we don't know. He doesn't know. They don't know either. We've just got to all remember that. We're just trying all to get our best guess.
Yeah, this is all predicting an unknown, the future. We don't know. But it's good to put the piece of the puzzle together and gather the opinions and perspectives of all of the greats and then formulate your own opinion.
I'll whip through this now because I've been talking in circles here. But they're split on real estate in the US this year. Some people are saying that the market's going to fall by as much as 20% from the top, in 2021 till the bottom of 2023. Others are saying that certain American markets are going to absolutely crank this year.
Okay.
So it's very, very split. What he did say is that rent returns in Australia and America will continue to go up as wages go up, and Australia in particular is chronically undersupplied from a rental perspective. Chronically undersupplied. I'll get to that more in a moment.
I got the data here on that one.
Phil is sort of suggesting, based on what the Fed's saying, that the US and Europe are going to go into recession this year.
A
technical recession. So that's 2 quarters of negative growth. The yield curve did invert a while back, and that normally suggests that we're in for either a serious or a technical recession within 18 months of that time, which will fall in this year. When that comes through, the media is going to freak everyone out, and then we'll be back to sort of normal once it passes again.
We'll see, hey?
The last one that he mentioned that I thought was interesting and very different to the mainstream media at the moment is they believe that inflation is getting under control in both the US and Australia. The Fed and the Reserve Bank believe that we're at a point where they've probably done enough, which it was pretty much, in terms of Australia, the largest recorded spike in interest rates in a single year in history. I don't know if that's verified, but that's what Simon Pressley was saying. But yeah, inflation...
300 basis points is a fair bit in a single year.
3% is good. What he did say is that it actually represents a good thing because there's a bit of a buffer there. If things go worse and they really do need to pull back, then pulling off a 6% interest rate back to a 3% gives a lot of people breathing space without the economy collapsing. So inflation will continue to ease, and he believes the next stage of the cycle is more credit, with the start of that easing, like that releasing of credit to come from 2023 forward.
Yeah, nice to hear that everything's just on track as well, because that cycle, as we've talked about in the past, has been unfolding for over 350 years in the United Kingdom, over 250 years in the United States, and over 150 years here in Australia. So to know that is unfolding as expected is giving us a bit of confidence, because he's indicated that he believes the cycle will peak around the end of 2026 or start of 2027.
Yeah, that's sort of what he's saying. And, the next phase of the cycle, according to him, is what he calls off to the races. It's the crazy phase. It's the heavy, heavy speculation you saw in the 3 to 4 years leading up to the GFC, where certain stocks, certain property prices go feral. And this is when people's savings start going to zero. People start using leverage more in stocks, in crypto, and in property. And this is when the banks really want to print money and make profit. And so it's a great stage as an investor if you're investing in the right products safely in the right market. But it can be a very dangerous stage if you don't know what you're doing.
Yeah, I think it's good to have conversations with people like you or me, or other mentors that understand this cycle, to help overlay it to your personal situation.
Exactly.
Because it really depends on where you're at in your investment journey as to how you trade the last part of this cycle.
You know, that's important to note because, like, let's say that you bought at the very top of the last cycle before the GFC.
Yeah.
You've still doubled your money on every stock you bought and every property you bought during that time. So if you're a long-term investor like Simon and I, this stuff means nothing.
Yeah.
If you're a short-term investor, then it means everything.
Absolutely. Now, I want to move on to talk about some of the information that came out of the SQM boom and bust report. Now, they create this every single year, comes out in January. Certainly worth a buy. There is so much gold in that article. So head over to SQM, purchase their boom and bust report, and you can analyze it yourself and, you know, formulate your own opinion from there. But they had some pretty interesting things to say about wage growth. They believe it should accelerate about 4% plus on average this year. Obviously, there'll be some winners and some losers there. You know, unemployment is sitting at 3.5%, which is extremely low right now, and there is heaps of jobs being created. Over 500,000 jobs were created over the last 12 months. So, you know, plenty of employment opportunities around Australia right now.
Without a doubt. And from reading this report, which is honestly one of my favourite things to do at the start or end of each year, you know, it looks like they've come out with 4 scenarios like they always do.
Yeah.
The most likely with things turning for the better sooner rather than later. And then like a worst case scenario with things like getting significantly worse in terms of inflation and how they have to deal with that as well.
Yeah, and what they did with those scenarios is they actually went back to their 2022 boom and bust report and told you how accurate they were.
Yep.
And then they've gone into the new scenarios as well, which, you know, 3 out of the 4 scenarios, and the 3 being the most likely outcomes, actually result in some positive growth in Australia, you know, somewhere between 0% to potentially 9%, depending on which one of the scenarios does actually unfold.
Yep, and that all just comes down to how unemployment goes, how inflation goes, and how the government responds to that stuff, right?
Absolutely, yeah. Whether or not they push interest rates too high, whether the unemployment rate goes too high or stays relatively low, all of those things were taken into consideration for the different scenarios.
And then you've got the doom and gloom scenario number 4, which is like pretty much we can't get it under control.
Can't get inflation under control.
In heavy like they did in the 80s and just go, well, it's not working, boom.
Yep.
And that will create some short-term pain for a bunch of people, as well as probably a decline in most property markets.
Yep. Then they went to talk about vacancy rates sitting at a 16-year low right now at just 0.9%, which is just chronically undersupplied. Now, we have a rule which we never buy in suburbs that have a vacancy rate above 2%, which is pretty rare to find anywhere in Australia right now, which is just insanely convenient, especially when you think about the amount of people that are moving to Australia at the moment, the lack of supply coming to the market, you know, Queensland in particular struggling with completing those construction projects at the moment. So it's just fueling that fire, which has resulted in rents in the capital cities around Australia coming up 21.8% over the last 12 months.
Wow. That's a huge deal, like, and I'm seeing it. Like, there's almost not an investor that I'm talking to that hasn't increased their rent on their properties in Sydney, Melbourne, or Brisbane by $100 a week last year.
Now, SQM was talking about the number of distressed properties on the market at the moment. And based on their research, with over 250,000 listings available right now, only 2.6% of properties on the market are selling under distressed conditions. Now, that sort of links us into some of the stuff that you found from Simon Pressley as well, which was talking about those distressed sales, because that's a narrative that the media is hooking onto at the moment. That's what a lot of people are fearful of. They think listings are going to increase because of this, but when you look at the actual listings, they're declining. And when you look at the actual statistics, it's a very, very small percentage of the market.
Yeah, like in a normal year, I think in the last 20 years, something like 400,000 homes have sold, or 420,000 homes. And I think last year, 460,000 homes sold. So people are still absolutely transacting on property. But I think one of the big ones is to look at, well, how are the banks trending in terms of arrears, which is the people that can't afford to pay their home loans and are behind on them, and 0.58% of borrowers, so almost half of 1% are in that category right now, which is certainly not the position we were in the GFC or previous cycles.
There was a interesting statistic. I don't want to say it because I don't know the exact numbers, but it was just how many people that are above the age of 55 actually own their property completely outright, which was the vast majority in that particular article. I think it was a CBA one.
Yeah, I remember reading something similar and talking to you about it last year, and it was something like 35% of Australians own their own property outright. Another 30% of people don't even own home or investment property at all. And then of that 35% that's left over, the average Australian has an LVR, like a loan to value ratio, below 50%. So what that says to me is that there is heaps of equity in Australian property, particularly after the last 3 years in Sydney and Melbourne. And as a result of that, the banks at some point are going to go, hey, our books look way better than they did 5-10 years ago. Let's just leverage up to the hilt.
Absolutely.
And that's what's coming next.
Yeah, that's what Phil says is coming next as well.
So if we go to CBA now, these guys are incredible. The reason they're incredible is because they have something like 38 to 40% of the Australian market. So it's a massive, massive cross-section of data that they can use to extrapolate to 100% of the population.
Yep.
And so the best data comes out of CBA. They're expecting the RBA to drop rates this year. They're saying they may go up slightly between now and June, and then they'll hold them, but then they're saying somewhere between September and December they'll drop them. And they're actually saying that they expect the Fed, which is like the Reserve Bank of America, to drop rates by 2% in January 2024, and they expect the Australian government, if required, will follow suit and do the same thing. So if that happens, in 1 month, a 2% drop.
What?
We've got to remember that the reason that they're increasing rates is twofold. One, it's the slow inflation, but what they're ultimately trying to do, right, is they're trying to take the cash out of people's bank accounts by charging people in like interest, extra interest, taking the money out so that people stop spending money on the economy and the economy goes back to normal.
Yep.
It's really twisted when you think about it.
Yeah.
They're taking people's savings by increasing rates by 4% so that they stop spending money, so the economy stops going ballistic because they lent people too much money during COVID. Like, it's actually twisted, but this is the system.
It's the system and the cycle that just continues to revolve, and we just forget about the past.
Yeah.
Forget when this has happened in the past.
It's happened so many times, and Simon Pressley talks about that. Like, we're talking so much about inflation because we've had a decade of none.
Yeah.
It's sitting at 6, maybe 7%, and there was the 70s and 80s where the average inflationary year was more than 10% for like 20 years in a row. So it's like give or take. Like, it's just,
and the reason,
it's a new thing to talk about.
The reason for that was because there was the baby boomers who were all in that age group of being like 20 to 40 back in the 70s and 80s. So they're all contributing, they're working, you know, and because you've got all of these people earning money, they're spending money. Like, there's always a method to the madness, and when you peek behind the curtain, you can generally find a bit more context.
Yeah, it's so simple. It's like the banks and the government gave too much money away too cheap. Shit, pull it in. Interest rates go up. Oh, we've overdone it. Let it go again. And that's all it is. And, you know, Ray Dalio talks about it in his book, Big Debt Crises. It's one of the 4 things that they have done for 100 years.
Yeah.
What else has CBA said? Most likely, this was interesting to me because we want you guys to be like 9 months ahead of where the market's at.
Yeah.
You're, just by listening to this stuff, 18 months ahead of the average person, but we want you to be 9 months ahead of the average investor in the market too. So most likely, the Fed and the Reserve Bank, according to CBA, have done enough to curb the inflation and got it under control.
Yep.
But there's some lagging stuff coming through around employment and energy that will throw the inflation numbers out for longer than they should.
Okay.
And so inflation is just a basket of goods, and energy's gone up and wages are going up, and that data is lagging. And so it's going to make inflation look pretty high until probably September, but in reality, they've probably done enough to smash it right now.
Yeah, good.
But they can't immediately pull it back because they need to bed it in and for people to just stop spending completely.
Yeah, it needs to be for long enough that it scares people.
Yeah, because the 2 things they can do is actually pull it up or they can tell people that they're going to pull it up, and both, based on 100 years of history, have worked equally well.
Okay.
So they're telling people right now that it's going up still, and that's what's keeping the market in fear and saving and non-spending.
But like the data at the end of the day might maybe suggest that it's recovered a little bit quicker.
Their preliminary data is saying it's under control, but they
Yeah.
they have to play the government thing, and they can't say that right now.
And they got a lot to lose as well, like by saying the wrong things.
You know, this report that we're talking about from CBA isn't like something that you're going to get from subscribing to CBA's weekly newsletter.
No.
This is a report that we get that is pretty much for clients of CBA, which neither of us are. We get this report through another person at the bank for just people in the bank that have more than $10 million of net assets. So this is stuff that isn't going to come out in the paper. When we're talking CBA, we're talking about the CommSec stuff. It's very different.
What I loved about CBA as well, which we didn't go into too much today, but we'll do a video on it, which was the state of the states.
Yeah.
And did you have any of that stuff written down here?
Only that Queensland's balling, and for the first time in the report's history, leading the nation in terms of the #1 economy now.
Yeah, which is really nice to see. And, you know, obviously this is the market where we're from. It's really where we see the most value over the next decade leading up to the 2032 Olympic Games, based on these previous growth cycles and based on previous support that the Olympics have had for other markets around Australia. Like back in Sydney, when they had the Olympics in 2000, from 1997 to 2003, the market increased 97% off the back of the Olympics, according to Homely, which was just insane. That was counter-cyclical for Sydney as well.
It was. Like, I cut that data recently just to have a look, and 60% of the growth in prices came in the 5 years leading up.
Yep.
That's important for people to know. We all know that everyone in Australia and people around the world are going to rush into Brisbane to, you know, potentially make short-term money, and that's cool. But the money is made before. So just remember that, guys, and, you know, try not to come rushing in 2 years after it's all over.
Yeah, and with Queensland topping it, you know, it's looking at things like population growth, it's looking at construction approvals, it's looking at...
Unemployment rates are the lowest in the country now.
Yeah, they were looking at about 5 major different things, but we'll definitely do another video on that state of the states, because that was pretty damn cool as well.
That was real cool. I actually haven't seen it before.
Yeah. You know, while we're on the Queensland chat, we'll talk about Michael Matusik's article where he talked specifically about Southeast Queensland. And the article was to make you aware of the fact that Southeast Queensland is not one market either. There is multiple markets. You've obviously got Brisbane, the Gold Coast and the Sunshine Coast, plus Toowoomba there. And each of those have markets within markets as well. Now, starting with the Gold Coast, he was indicating that demand for properties between $750,000 and $1.5 million plus will likely plateau in early 2023 and will increase in value by mid to late 2023. And there was some solid demand for these properties. It hasn't been dropping, it's actually been trending sideways and upward. Yeah. Then Sunshine Coast, the median value has fallen $90,000. But most of this was captured in the top end of the market.
Noosa, Peregian, Sunshine Beach, like where the average homes are $1 to $20 million, really. Yeah,
so he said properties valued over $1.5 million plus have seen the largest declines. And that makes sense. When inflation's high, when interest rates rise, it can be harder to secure finance to secure those properties. Plus, they saw the biggest booms in 2021.
The higher properties, more expensive properties in markets always lead, and they lead the up and they lead the down.
Yep, and then he said there is likely some further declines at the top end of the market, so $1.5 million plus in early 2023 before stabilising towards mid to late 2023. But the core housing market, so around the median house price, basically properties between $500,000 to $1 million still remain strong, and he perceives those properties to potentially see some decent capital growth this year.
Interesting.
And then looking at Brisbane, the median values have fallen 6% over the last 12 months, with the top end once again seeing the largest declines and being the softest, that being $1.5 million plus again. But when you look at the core market, once again being between 500K and $1 million, still remains strong and in demand. Further declines in 2023 for properties valued between $500,000 and $1 million are likely over.
Interesting.
So he doesn't believe that there's any further price declines to occur in Brisbane for properties between 500K and $1 million.
Again, we'll take it with a grain of salt. Like, all of this cool data, and, you know, don't bet the house on it. But that's really positive to hear.
Yeah,
and something we're feeling, like, I have seen prices drop.
Yeah.
Even in the sub 700K market of Brisbane. But they have stabilised, and people are coming back, man. Like, I'm seeing houses sell in a couple of days or a day again, multiple offers. Instead of one person rocking up a fortnight, we're seeing 10 people rock up a week. It is what we didn't know late last year was how high rates would go. But now everyone knows that it's going to be 5 to 6%, and people will either make one of two decisions. I can stomach that and I'm going because I have a vision of buying before the Olympics, or I'm just sitting out. This isn't for me. Cool. Like, when we get closer to the top of the cycle and everyone feels good and properties have gone up 20% the year before again, you know, that's when those guys jump in. And that's cool as well. Like, that's fine if you're holding for 30 years. It doesn't matter either.
Yeah, absolutely. Just depends on where you're at right now.
Yep. You know, and I've bought properties at the top of markets and the bottom. And I personally really I decide to invest based on my personal plan and if I have a deposit. And then I just buy. All of this stuff that we're talking about here is to give you a massive competitive advantage over the average. But working a plan consistently over 15 to 30 years and having fun with it is way more important to me than the year-by-year stuff. Like, we do this because we geek on it.
Yeah, it's a passion.
But I don't care about any of it really.
No,
like, I care about it to help people, but I don't care about it on, like, I'm not looking at my properties and going, shit, I just lost $200,000 on my $2 million portfolio last year because the market went down. I'm like, I don't even think about it. I'm like, oh, my rents went up 25K. You know, like.
Exactly. And you just got to have that belief system. And that's what I created before I even bought my first investment property. And that's what everybody should do. You know, you don't just go out there and buy real estate willy-nilly hoping that it's all going to work out. You create a plan, you create a belief system, you do your research, you understand the fundamentals and the potential long-term trajectory, and start taking action, because regardless, you're never going to be able to pick the bottom, the middle, or the top of any cycle. So long-term investors will always win in the long run.
That's so true, man. Like, I'll move into Simon Pressley now. This was by far the funnest thing I've read work-wise in years. Like, I highly recommend checking out his 2023 market predictions on his website, Propertyology.
Yep.
But basically, if we look at John Lindemann, property prices in Australia have increased by an average, when you look at the total return by the number of years, 11%.
Yep.
Through the last 100 years.
Yep.
The last 50 years, if you look at home lease stuff, they've done Sydney, Melbourne, Brisbane, total return divided by years, 9.7%. And if you look at the CoreLogic stuff that you sent me recently, the 30 years, it's been even above that. Like, it's been, Sydney and Melbourne have done an average of like
15%.
When you, again, say not compounded but averaged out, it's crazy.
It is nuts. It is actually nuts.
And so it's like, the lesson is, in the 15-year period that we're all going to invest, you're going to see minus 30% years possibly. You're going to see plus 30% years, and you're going to see a whole lot of in between. And in 15 years, you'll look like a genius on a straight line. And year to year, you'll look like an absolute lunatic, because it's going to go up and down like a yo-yo.
And if you're sitting here listening to this going, well, if it's done so well in the past, how can it do that well in the future? You've got to go watch every single video from Property Share Market Economics on YouTube, because they will tell you exactly how and why that will continue happening.
You know, I've told this story to you before a bunch, but like, I read Opar's diary.
Yep.
And he said, like, I don't know how I'm going to pay off my property. I can't. Did he pay $6,000?
£6,000.
$6,000
back in the 50s or something.
Even, yeah, I don't know when, but he bought a property on the northern beaches at the top of the hill in Dewey.
Yep.
Across the road from a park on a busy road for $6,000, and he's
Dewey,
like,
is that what the locals call it?
Dewey. Why did he sell it?
Why did he sell it? Yeah, seriously.
But you know, this property went from $6,000. I think they got out of it for like over $1 million.
$2 million, over $2 million.
Really?
Yeah.
I thought it was 1.4.
No, they kicked us, because you got to remember, like, Mum wiped all of her debt and bought an investment. Uncle Tim wiped his debt and bought an investment. Auntie Jewel bought 3 investment properties.
And Auntie Nick paid off her house
bought
too.
her home and paid off the debt as well. So
One property.
none of them had the cash before they got that. But yeah, true. So it was significant. I think 2.2 mil.
In his diary though, he's like, I don't know how I'm going to pay this off. This is 30 to 35 years of my working life.
Yeah.
And, you know, I think I can't remember what he was earning, but it was crazy. And he was a surveyor working on like the Snowy River project at the time.
And you hear stories about mum and dad buying their first home in Engadine back in the late 80s, early 90s. And same thing, dad had to pick up a second job. It was the biggest investment that they'd ever made. It was going to take them 30 years to pay off. So it's always been that sentiment. And then when I went to the bank to get my first property, you know, with the money that I was earning at the time and how much debt I was committing to, it was going to take me 30 years. So it's been pretty consistent historically.
Love it, man. It's the truth. So Simon Pressley goes on to say that the conditions are some of the best in Australian history, despite the monster amount of debt that the government's carrying. Luckily, there is a global resource energy construction boom happening right now that nobody's talking about, that is sucking so much stuff out of the Australian ground. And thankfully, this stuff is so profitable that it is just wiping government debt at a rate 10 times faster than they were expecting to. I'm just so grateful for that, man, to be in Australia. And then to have a government, instead of taking it all, is reinvesting it back in the economy.
Yeah, it's interesting, like obviously with China and Ukraine, Russia and Ukraine having so many natural resources and energy resources under their land, but then with the sanctions, they can't distribute that, they can't export that around the world now. So all of the other countries around the world, like Australia, that have these minerals underwater, these energy resources, then, you know, it becomes more valuable and profitable for us to mine it and sell it.
Oh yeah, like the commodities are booming. Like the price of certain things have doubled in 3 years.
And what does Phil say about the second half of the cycle with commodities?
Always go off. Banks and commodities are the stocks you want to be in. And the Australian stock market, when you take the 5 major banks and the 2 biggest mining companies, BHP and Rio, are 50% of the Australian stock market, 7 companies. So it's exciting.
Yeah, it really is.
I was talking to a client yesterday, Gus. He's just sold his business and he's doing full-time futures trading.
Good.
We talked for an hour about what he's up to. And we were just talking about Phil's stuff and some stuff he's hearing and seeing. And he's actually gone back and looked at the last 100 years in the States and America and Australia on real estate cycles. And, you know, some of the stuff he was telling me that he's expecting, like he expects the Australian stock market to do 70 to 100% the next 3 years, when Akil, who works with Phil and is a lecturer at Oxford University, is suggesting the same thing. Even when we had lunch with Phil and the Goldie last year, he's sort of, I fell off my chair, but he's saying 50 to 70% price growth in house prices in markets that haven't boomed in Australia in the next 3 to 4 years.
Your Brisbane's, your Perth, Adelaide.
Simon Pressley in last year's report reckons some markets in Australia will do 100% the next 4 years. So
where's he at these days?
He's not putting those numbers out there anymore because it's dangerous to do so.
It is dangerous to do so.
But we got record low housing supplies. The tourists are coming back.
Yes. Big time. I went travelling overseas over Christmas and New Year's for my honeymoon, and oh gosh, and got my neck.
It's
cooling down. It's going down to my pants. Pants in my pants. But like I caught probably 10 or 12 planes, a couple of buses, a couple of trains on this trip, and like, you know, every single plane was a sellout, every single bus was a sellout, even the trains were a sellout. Like every single hotel was packed to the rafters, every single restaurant packed to the rafters. Everybody's getting back out there and traveling, and you had the same thing locally here in Australia, like caravan parks not being able to get into and stuff like that.
Yeah, it was weird. Like some of the places were so packed, and then other places, I don't want to mention their names because
we'll be going back there. Yeah,
but they were empty, and I was like, this is odd. But you know, the cool thing is like this $120 billion worth of infrastructure that I mentioned before for the next 10 years in Australia. That's a big deal. Simon's predictions are that interest rates will sit flat, potentially going up and then declining before the end of the year, with the big stuff coming once we figure out where we're at by July towards the end of the year, and then they'll make a decision as what to do. You know, what the government didn't really tell anyone is 155,000 people came in the first half of 2022 once they let the international borders open. They're giving visas out like kids at a lolly shop right
Apparently
now.
it's easy at the moment.
You know, there's some crazy stuff here. Like in 2023, 500,000 students are going to come back to Australia. And then on top of that, they're going to let 200,000 more migrants in.
Wow.
Now, we're sitting in a vacancy rate of 0.9%, and Australians are sleeping on the street and in cars. Add 700,000 people to that mix with no new property for them to move into. Like, you know, that's why CoreLogic's saying rents will go up another $100 a week this year in Australia.
Yeah, I think they were saying about 240,000 new dwellings should be constructed in the 2023 calendar year, but construction companies aren't completing these projects as quick as they would have hoped to.
Yeah, you know, he's gone on to say that this is the biggest rental crisis in Australian history.
Wow.
And it's come off the back of those hard changes that APRA made to investment lending for developers back in 2015. Simon believes that Sydney, Melbourne and Darwin have the weakest fundamentals.
Yep.
And they're also the markets that have had the most speculation in the last 10 years, really. He believes that Brisbane and then Perth and Adelaide look really solid, which is being reaffirmed by everyone we've talked to today as well.
Yeah, it's really interesting to see all this information come out. Definitely paints a different picture than what people are feeling, obviously with sentiment being quite negative. Basically, sentiment's at the same level that it was in 2008, 2009 during the global financial crisis. So people are feeling really bad about how things are unfolding, but it's nice to go through all of these different people that don't necessarily have any connection to each other, and they're throwing out their bold predictions, and, you know, looks pretty interesting, looks pretty fine to me. It gets me excited. It
gets me excited because he actually goes on to say that outside of Sydney and Melbourne, he believes that most regional and metro locations in Australia will do somewhere between 2 and 7% in 2023.
There you go.
I don't know. We'll see what happens. But what he did say is that there's now around about almost $1.5 billion in cash savings as of June 2022, which is up $500 million on the numbers we're giving in 2021.
Yeah.
Like, people are saving money, people have equity, and people have been sitting out of the market realistically, like most people since 2020. So at some point, the combination of that perfect storm with the government saying, go for it, banks, is going to result in some pretty interesting stuff in the stock and property markets.
And we're starting to see those things happen over in the United Kingdom. They've just changed their lending criteria and they're not putting the 2% calculator on top of the interest rate. So, for example, if a bank was to assess you at maybe a 5 or a 6% rate, they're actually going to assess you at a 7 to 8% rate to make sure that you can hold that property as interest rates rise. So the UK has just abolished that, and what Phil indicates at some stage in the second half of the real estate cycle, generally before it's off to the races, we start to see easier lending, easier credit and things like that. So we'll have to wait and see how it all pans out, right?
You know, these banks aren't silly, and so if the rates are going up, they make the lending criteria easier. And normally as the rates start coming down, they'd make it harder. But what we should see in the second half and final stages of this cycle is as the rates begin to come back down again, which they will, and then towards the end of the cycle, they'll bump them up again, will be like rates coming down, but for the first time in 15 years, ridiculously easy credit at the same time and ridiculously easy lending limits. Now, one thing I talked about a bunch last year is that between 2002 and 2008, interest rates rose from 4%, 22 times over that period to above 7%, and house prices in everywhere but Sydney and Melbourne went up by more than 100 to 120%. I think Brisbane did 127% over that time. Perth went really well as well, which is consistent with Phil's stuff, which is Sydney, Melbourne, New York, London, Singapore, Beijing do extremely well in the first half of the cycle. And I learned something yesterday too from talking to Gus, and that is I believe that the bigger economies like UK and America are also do better in the first half of the cycle. And then the secondary economies, like the secondary cities of Sydney, Brisbane and Perth, and Australia being a secondary economy, do better in the second half of the cycle. And based on his 100 years of research, he could see that clearly. Like American stock prices boom in the first half and sometimes do well in the second. Australian stock prices do very, very well in the second half with the commodities and the banking stocks going through the roof.
There you go.
Crazy. Just every day learning new stuff, hey?
Yeah, seriously. You know, it's good to be curious.
Keep being curious.
Keep being curious and do the work, do the research. And, you know, sometimes you read articles and it gets you a little bit stressed out. Then you read another one, gets you really excited. And, like, for me, it's just a culmination of all of them to formulate your own opinion and belief system to step to where you want to be and execute those next steps, which are always going to feel scary, whether it's a good market, a bad market. Buying property is hard. Buying property is a little bit scary.
Big debt,
but go for long term. You know, it clearly works out. 453% is the increase over the last 30 years for houses in metro markets. So, you know, not saying that's going to happen over the next 30, but anywhere close to that would be lovely.
man, if I got half of that in the next 30, I'd be absolutely stoked. And that would just mean a 4.8% increase per annum over that period of time. We're not trying to break records. I've loved this update, man. I love doing this. It's really helped me get my thoughts around the market. Some of these guys like Phil Anderson, Fred Harrison, Simon Pressley, Michael Matusik, CBA, SQM, they're absolutely phenomenal. They're adding tools to your belt so that you can make better decisions. Sometimes the best decision for a year is just to do nothing, save some cash, pay off some debt. Sometimes the best decision for other people on the advice of their accountants or planners could be to, you know, you are in a strong position and there's not as many people looking, and in some markets there is a big discount right now and things are looking better in the future than they were in the last 12 months. So for some people, taking one step into the market or at least committing to saving and learning could be a good thing.
100%. It's been good to talk through this. So please share the video, share the podcast with people that need to hear this at the moment, that just need a little bit of a different perspective, and watch it a second time so that hopefully some of that info sinks in.
Yeah, for sure. And the last thing I'll ask, guys, if you are watching this on Spotify or Apple, you know, give us a 5-star review. That's the only way their algorithm picks up if like other people should hear this or not. So we just wanted to wish you guys the best year. And I'm so grateful to bring this stuff to you early, remembering that it's 18 months before anybody else will know this stuff really.